Hello, I'm Richard Weinberger, the CEO of the Association of Accredited Small Business Consultants. I'd like to talk to you today on this video a little bit about financing small businesses, equity financing in particular, and then a couple of terms to make sure you're familiar with them. Now, if you're working as a consultant with small business clients, you know that there are numerous ways to finance a small business, and invariably, anytime we talk about small business, financing seems to pop up as a topic that everyone is interested in. Now, there's advantages and disadvantages of all types of financing, and part of the difference in the advantages and disadvantages, and that is why a business is actually going out and getting financing. Is it for startup capital? Is it for working capital, or is it to expand? One thing that's really important to understand, and that is a choice that is made today has implications tomorrow. So you and your small business client want to make sure that you prudently look at all of the various options for financing and decide what is going to be most beneficial for the small business, not only today, but also tomorrow. So the big question is, does a small business use debt financing or equity financing? So let's just talk today on this video about equity financing. Sometimes it's referred to as risk capital or equity capital. It's referred to as risk capital because this is the amount of money that is actually at risk. This is money that the owner or owners or investors have put into a business, and if the business goes under, that's the amount that they're at risk for. That is the amount of money that they're going to lose. Now, equity capital can, again, either be from one owner. It can also be from outside investors. And unlike debt financing, equity financing is not repaid. It's not a liability of the business, but it's owner's equity. It's money that has been invested in the business. Now, when outsiders invest equity money, what they're looking for is a share of increase in the value of the investment, no different than if they were going out and investing money in the stock market. They're looking for an ROI, a return on their investment. They're looking for the same thing when they invest in a small business. They're hoping to receive dividends or distributions depending on how that business is actually organized, whether it is a general partnership, limited partnership, C corporation, S corporation, LLC, limited liability company, but they're looking for dividends or distributions, and obviously then, as I mentioned before, a return on their investment. Now, when owners receive money coming in from outside investors, one thing that they have to realize, they are giving up a percentage of ownership. Because again, an outside investor is going to be a part owner. So the question becomes then, well, how much will be invested? In other words, on the percentage of ownership that they're giving up, how much are they going to have to give up? Well, again, that depends how much is invested by outside investors, how successful the company has been in the past, and what the future prospects are of the business. Now, this really becomes a philosophical question for an owner, and that is it better to have 100% of something small, or is it better to have a smaller percentage of something large? And that can be where outside investment helps that business grow. But that owner has to decide, well, how much of that percentage ownership am I going to give up to get the capital that I need for startup, working capital, expansion, something like that. Now, questions that the owner has to ask when contemplating, do I want equity financing? Do I want debt financing? Do I need financing? And that is, what are the potential benefits for the business? How is it going to help out? Will the outside capital give the business necessary working capital to stay afloat, if that's what the problem is? Will it give the business necessary capital to expand, if that's why they're looking for business? And again, that's what I mentioned here. Is it better to have 100% of something small or a smaller percentage of something large? And what I mean by that, let's say if a business is worth, let's just say $100,000, is it better to have 100% of that business that is worth $100,000, or will outside capital allow the business to grow? Maybe it'll be worth $500,000. Is it better to maybe have 80% or 70% of something much larger? Very, very philosophical question that every small business owner has to contemplate, has to answer himself. There's no right or wrong answer, and the question becomes, do I want to stay where I am? Do I want to expand? Do I want to get outside investors? Now, a sole proprietorship will only have equity financing from the owner. That's why it is a sole proprietorship, a one-owner business. So if a sole proprietorship then receives additional financing, what's going to happen, the organizational structure has to change. It cannot be a sole proprietorship business if it has more than one owner. So at that time, then that business structure is going to have to change into some type of partnership or some type of corporation or LLC. All right, there's a couple terms I want to make sure that you understand, and it's used a lot in small business financing. So if you're not familiar, let's go over with what these terms are. One is called skin in the game. This is the amount of money that the owner or owners actually have invested in the business. How much equity capital have they put in? What is their at risk? And this is something that investors and lenders look at, because they want to know, well, how confident is the owner or owners, if there's a group of owners, how confident are they that the business is going to succeed? How much of their own capital have they put in? In other words, let's say if the owners maybe only put in a small amount, 5 or 10%, let's say, just taking that as an example, and they're trying to borrow 90%, well, investors or lenders are thinking to themselves, well, how come that owner hasn't put in more money? On the other hand, if the owner has put in, say, 50 or 60%, then that puts a different light on things. Now, obviously, a lot of times owners are not going to have all of the capital to put in. Obviously, that's the reason that they're going to outside investors or lenders. But skin in the game, the amount of risk that somebody actually has in the business, is a huge qualifier when outside investors or lenders are looking at either investing money or loaning money into the business. Now, another term that I want you to be familiar with is called the burn rate. And basically, I'll just read this. How fast cash will be consumed in a business before the business either starts making a profit or cash flowing itself or closes for lack of cash. This is something else that investors and lenders look at all the time. What is the burn rate? In very simple terms, and that is, well, is a company burning up $10,000 a month? Is it burning up $20,000 a month? How many months are they going to go through the money before they either start cash flowing themselves or they can't get any more money and they're going to have to close the doors? So the burn rate is really important, and that's why a cash flow budget is really important for any business, whether it's a startup business, whether it's an ongoing business, but especially for investors and lenders. They're interested in, well, what is the burn rate? In other words, how long is the business going to be able to stay in business and have working capital, sustain operations until they either again start cash flowing themselves or they need additional money. So a burn rate is expressed again in terms of how much money is the company burning up monthly and how long is it going to take before it starts to cash flow. So again, as the example I gave, a burn rate might be $10,000 a month for the next 6 months. That's what that burn rate is going to be. So then this doing a cash budget and figuring out what the burn rate is gives an idea of how long a business can operate with the amount of money on hand or will be available either through operation loans or equity investment. That's what we're trying to figure out, and that is, how long is the company going to be able to sustain the operations by burning through cash until the business starts actually making a profit. So again, there are advantages and disadvantages of all types of financing. We went over equity financing a few terms here, but again, keep in mind that whatever choice is made today, it's going to have implications tomorrow. Hope you enjoyed the video. Thanks for watching.